The global financial markets are a whirlwind of activity, a dynamic dance of risk and reward. From Wall Street to Canary Wharf, investors and businesses alike are navigating a landscape riddled with uncertainty. Three key themes dominate the current narrative, each wielding the power to reshape portfolios and redefine investment strategies. The Federal Reserve has made a momentous decision: interest rates shall remain steady. Meanwhile, from the bleeding edge of technological innovation emerges a new disruptor: DeepSeek, an artificial intelligence chatbot hailing from China. Investors are left pondering, is this a technological paradigm shift, or merely a fleeting moment of market hype? The United Kingdom, grappling with the aftermath of Brexit and buffeted by global economic headwinds, faces a sobering reality. In this era of financial complexity, knowledge is power. Investors armed with insight and understanding are best positioned to weather the storms and capitalize on emerging opportunities. Join us as we delve into the intricacies of the Federal Reserve's recent decision, dissecting its implications for investors across all asset classes. We'll explore the intricate dance between inflation, interest rates, and market sentiment, providing you with the tools to make informed investment decisions. Our journey then takes us to the forefront of technological innovation, where we'll examine the disruptive potential of DeepSeek. Finally, we'll turn our attention to the UK, providing an in-depth analysis of the economic challenges facing businesses across the nation. We'll examine the factors driving business distress and explore the potential consequences for the UK economy. The Federal Reserve has opted to maintain the current federal funds rate, holding it steady at a range of 4.25% to 4.5%. This decision reverberates through the corridors of global finance, sending a clear signal. The Fed is proceeding with caution. For months, market watchers have been on high alert, parsing every utterance from Fed officials for hints of a shift in monetary policy. The decision to hold rates steady has injected a fresh dose of uncertainty into the markets. Investors are now left to grapple with the implications of this calculated ambiguity. Is this a mere pause in the Fed's tightening cycle, or does it signal a more fundamental shift in the Fed's thinking? Understanding the rationale behind the Fed's decision is paramount in this era of heightened market sensitivity. At the heart of the Fed's decision-making process lies a singular preoccupation: inflation. This insidious economic force, if left unchecked, can erode the value of savings, stifle investment, and destabilize entire economies. Recent data suggests that inflation, while still elevated, may have peaked. The Consumer Price Index has shown signs of moderation, offering a glimmer of hope. However, the Fed remains wary of declaring victory prematurely. The Fed's mandate requires it to pursue both price stability and maximum employment. These twin objectives can often be at odds in practice. Lowering interest rates can fuel inflationary pressures, while raising rates can dampen economic growth. By maintaining its current stance, the Fed is buying itself time to assess the impact of its previous rate hikes. The Fed is acutely aware that moving too aggressively in either direction could have unintended and potentially damaging consequences for the economy. The initial market reaction to the Fed's announcement was a mix of relief and apprehension. Stock markets, after an initial surge higher, gave back some of their gains. Bond yields edged lower, suggesting that investors are anticipating a less aggressive Fed in the months ahead. The US dollar weakened slightly against a basket of major currencies. Gold rallied on the news as investors sought refuge from market volatility. These market movements paint a picture of cautious optimism tempered by lingering concerns. Investors are grappling with a complex interplay of factors including inflation, interest rates, and geopolitical tensions. For investors, the key takeaway is that volatility is likely to persist in the near term. Navigating this environment requires a steady hand, a long-term perspective, and a willingness to adapt to changing market conditions. In the rapidly evolving world of artificial intelligence, a new contender has emerged from the East. DeepSeek, a sophisticated AI chatbot developed in China, has arrived on the global stage. The emergence of DeepSeek highlights the increasingly competitive landscape of AI development. Early reports suggest that DeepSeek possesses an impressive ability to understand and generate human-like text. The potential implications of this technological leap are vast, touching everything from customer service chatbots to content creation. The question on everyone's mind is whether DeepSeek represents a genuine technological breakthrough or simply another instance of inflated expectations. The ripple effects of DeepSeek's emergence are already being felt throughout the tech sector. NVIDIA's stock, a bellwether for the AI industry, has taken a hit as investors grapple with the potential disruption posed by DeepSeek. NVIDIA's GPUs have become synonymous with AI development, powering the complex computations required for training and running large language models. However, DeepSeek's arrival raises questions about the continued dominance of NVIDIA's hardware. Companies that have invested heavily in specific AI technologies now face the prospect of their investments becoming obsolete. For investors, this underscores the importance of diversification and a willingness to adapt to rapid technological advancements. DeepSeek's capabilities hype or true innovation? While the arrival of DeepSeek has undoubtedly shaken the tech industry, the true extent of its capabilities remains uncertain. Early reports suggest that DeepSeek possesses impressive language processing abilities. Users have reported that DeepSeek excels at tasks such as summarizing lengthy documents and generating creative content. However, it is crucial to approach these claims with a healthy dose of skepticism. The AI field is notorious for its hype cycles. A key factor in determining DeepSeek's long-term impact will be its accessibility and integration into existing workflows. If DeepSeek proves to be versatile and easily integrated, it could have far-reaching consequences for the AI industry. The global AI landscape, a shifting balance of power. The emergence of DeepSeek from China highlights the increasingly global nature of AI development. While the United States has long been regarded as the epicenter of technological innovation, China has emerged as a formidable competitor. DeepSeek's arrival serves as a reminder that innovation knows no borders. This has significant implications for governments, businesses, and investors alike. The competition between China and the United States in the field of AI has profound economic and geopolitical consequences. The AI landscape is undergoing a period of rapid and unpredictable transformation. A sea of troubles, UK businesses grappling with distress. Across the English Channel, a different kind of storm is brewing, one that threatens to engulf UK businesses. The latest figures paint a grim picture. Business distress is up by a staggering 50%. The economic landscape of the UK is increasingly treacherous, with businesses facing a barrage of challenges. From soaring energy prices to supply chain disruptions, the post-Brexit era has been anything but smooth sailing. This isn't just about numbers on a spreadsheet, it's about real people's livelihoods hanging in the balance. Small business owners are facing the agonizing prospect of closure. Employees are facing the threat of job losses and economic uncertainty. The question is, will policymakers take decisive action to avert a full-blown crisis? The pain of the UK's business distress is not evenly distributed. Certain sectors, once considered the backbone of the economy, are now buckling under the pressure. Hospitality, leisure, and retail are bearing the brunt of the downturn. The COVID-19 pandemic dealt a devastating blow to these sectors. Just as they were beginning to recover, they were hit by a perfect storm of economic headwinds. Restaurants and pubs are now struggling to fill tables. Retail stores are seeing foot traffic dwindle as shoppers tighten their purse strings. The question now is whether these struggling sectors can weather the storm and emerge stronger on the other side. The challenges facing UK businesses are not isolated incidents, but rather symptoms of a deeper malaise, a confluence of factors that have created a perfect storm for economic distress. Understanding the root causes of this crisis is essential for crafting effective solutions and preventing a repeat in the future. One of the most significant factors is the ongoing cost of living crisis. Inflation, fueled by supply chain disruptions, soaring energy prices, and the war in Ukraine, has eroded consumer purchasing power, forcing households to cut back on discretionary spending. This has had a direct impact on businesses, particularly those in consumer-facing sectors. Adding to the burden is the UK's complex and ever-changing tax system. Businesses, particularly small and medium-sized enterprises, often cite the administrative burden and high rates of taxation as major obstacles to growth and profitability. The government's recent decision to raise taxes while intended to shore up public finances has only added to the pressure on businesses already struggling to stay afloat. Brexit, the UK's withdrawal from the European Union, has also cast a long shadow over the economy. While the full impact of Brexit is still unfolding, it has undoubtedly created uncertainty and disruption for businesses. New trade barriers, customs checks, and immigration rules have added complexity and costs for businesses that rely on trade with the EU. The UK's economic outlook remains uncertain, with businesses facing a multitude of challenges. However, amidst the gloom, there are glimmers of hope. The government, acutely aware of the economic headwinds, has announced a series of measures aimed at supporting businesses and stimulating growth. These measures include tax cuts for businesses, particularly small and medium-sized enterprises, as well as increased investment in infrastructure and skills training. The government has also pledged to reduce red tape and bureaucracy, making it easier for businesses to operate and expand. Whether these measures will be sufficient to avert a full-blown recession remains to be seen. The UK economy is facing strong headwinds, and it will take time for these policies to have a tangible impact. Much will depend on external factors such as the trajectory of the global economy and the outcome of the war in Ukraine. The coming months will be crucial for the UK economy. The government's response to the business distress crisis will be closely watched by investors and businesses alike. A decisive and effective response could help to restore confidence and set the stage for a sustained recovery. However, further missteps or inaction could have dire consequences for the UK's economic future. The global financial markets, much like the intricate patterns of a labyrinth, present both opportunities and pitfalls for the discerning investor. The Federal Reserve's recent decision to hold interest rates steady, while offering a temporary respite from the volatility of recent months, has done little to dispel the underlying uncertainty that permeates the global economic landscape. Investors, faced with a confluence of conflicting signals and a constantly shifting landscape, must tread carefully, relying on a combination of prudence, adaptability, and a keen understanding of the forces shaping the markets. The days of passive investing, of simply riding the waves of a bull market, are long gone. Today's investors must be active participants, constantly reassessing their portfolios and adjusting their strategies in response to evolving market conditions. The emergence of DeepSeek, the Chinese AI chatbot poised to challenge the dominance of established players, serves as a stark reminder that technological innovation can disrupt even the most entrenched industries. Investors who cling to outdated assumptions or fail to adapt to the rapid pace of technological change risk being left behind. Meanwhile, the economic challenges facing UK businesses, particularly in the hard-hit sectors of hospitality, leisure, and retail, underscore the fragility of economic recovery and the interconnectedness of global markets. Investors must remain vigilant, monitoring developments not only in their domestic markets but also in key economies around the world. In this era of unprecedented complexity and rapid change, knowledge is the investor's most valuable asset. Staying informed about global economic trends, central bank policies, technological advancements, and geopolitical developments is no longer optional. It is essential for making sound investment decisions. Investors must cultivate a discerning eye, learning to distinguish between noise and signal, between hype and genuine innovation. The financial media, while often providing valuable insights, can also amplify market sentiment, creating both unwarranted fear and irrational exuberance. Investors must develop the critical thinking skills to separate fact from fiction, and to base their decisions on a sober assessment of the risks and opportunities presented by the markets. Diversification, a cornerstone of prudent investing, remains as relevant as ever. Spreading investments across different asset classes, sectors, and geographies can help to mitigate risk and enhance returns over the long term. Investors should also consider alternative asset classes, such as real estate, commodities, and private equity, which may offer different risk-return profiles and a hedge against inflation. Finally, investors should remember that investing is a marathon, not a sprint. Short-term market fluctuations are inevitable, and attempting to time the market is a fool's errand. A long-term investment horizon, coupled with a disciplined approach and a sound understanding of market fundamentals, is the most reliable path to achieving one's financial goals.